Here's an investment tip for you and why you should seriously consider investing or trading in the big three banks because they've historically recovered from a market crash. My name's Jessica Amir, a market strategist here with Moomoo. It's great to have your company for the weekly on this 23rd day of May. But first, I will note no broker out there will tell you what we're about to tell you. In fact, every single investment house goes against what I'm about to tell you, but this could be making you a lot of money. So consider that some of the best, if not the biggest investment funds in the world historically have been buying shares waiting for pullbacks, typically buying shares after they've fallen 10%, knowing that throughout history, we've seen some of the biggest stocks recover and hit record all-time highs. So how could you consider doing the same in Australia? Well, I propose that you consider looking at Australia's biggest banks, namely Commonwealth Bank of Australia, Westpac, and NAB. Let's dive into the strategy of how this works, and let's use CBA as a textbook example. Okay, now, so we all know the Commonwealth Bank of Australia is, of course, Australia's biggest listed company on the ASX. On the ASX 200. It's got a market capitalisation or a market size of 291.5 billion Aussie dollars. It's our biggest bank here in Australia, and not one broker or investment bank in Australia will tell you to buy. In fact, 13 brokers reckon you should sell CBA shares today. But I'm telling you to consider potentially maybe buying it with a long-term view, or maybe consider buying it when it pulls back, because CBA has historically always recovered from a market crash, and it will probably continue to do so. Let's have a look at CBA shares of late. Here's a chart of CBA shares. We can see that it's had 6 separate pullbacks of 7 to 15% over the past 2 years. And every time it's fallen, it's recovered and hit a brand new record all-time high. Now, let's just consider, what if you bought CBA shares when they fell 15% across the space of 1 month from Feb to March recently? They got as low as $141.41. So if you bought then and held till now, Bob's your uncle, Fanny's your aunt, you would have made 22%. So CBA shares are now at a record all-time high price, or record all-time high territory, $174.15. So if you, in fact, bought them 2 years ago and held them to today, you would have made 76%. 5 years ago, CBA was far less. Here's a chart showing what CBA was. CBA was $58.65. And over the past 5 years, CBA shares have gone up 194%. Annualized, your maths is probably better than mine. That works out to be 24% per annum annualized. But CBA shares will probably keep on going up. Why is that? Well, remember, I always say earnings drives share price growth. After all, we do know that CBA, their revenue is expected to grow 5%. Let's bring you that in pictorial format now. Here's a screenshot of Moomoo's platform. For those that are tuning in on the podcast, we're just flashing up what it looks like on our platform here. We can see that revenue is expected to grow. The market suggesting their revenue will grow 5%. The average analyst also sees CBA's net profits growing 36% to a brand new record all-time high of $10.3 billion. Just extraordinary. Now, CBA critically is embedded into the fabric of Australia's economy. 25% of Australia's mortgages are with CBA. So given the home loan market is $2.2 trillion and CBA's got $550 billion in residential mortgages, it's just outstanding. That's something for you to consider. Also consider that mortgage demand is rising thanks to the first home saver incentives, and we've also got Australian property prices. They're on a strong trajectory. Property prices will probably continue to rise. Obviously, we've got a property shortfall. We recently talked about this. Plus, we've also got rising demand amid exploding immigration. Now, CBA, what about their cash position? CBA is in an extremely strong position. In fact, Bloomberg Intelligence has gone out and they've surveyed their surplus capital. It's well above regulatory minimums. For example, there's a an acronym that we use. It's called SETI. It's basically suggesting that the capital ratio is 11.1%. That means, it's a bit complex, but bear with me, they basically have got $8 billion in surplus capital. All you need to know that this is a very large cushion. In fact, the biggest cushion out of the big banks. It's a big cushion there to basically fall back on in uncertain times, and it supports CBA continuing to pay their dividends and their share buybacks. What else? Why else am I saying you should consider buying CBA shares when they pull back? Well, CBA accounts for 11.1% of the entire Aussie share market, and every quarter, $4 trillion of our superannuation system is basically going into buying CBA shares. Not just CBA, but the other banks as well. And this is why I'm telling you that no matter what price CBA is, we continuously see steady institutional support. And this is why CBA shares rebound time and time again. So if you're looking for a reliable long-term opportunity tied to Australia's economic backbone, then investing in the big banks is probably worth your consideration, particularly given this is a proven wealth strategy. Here's a chart of what we've seen the big four banks shares do throughout over time. Also, do note that CBA, National Australia Bank and Westpac are the only big banks that have always recovered from a market crash. ANZ is the laggard in this case. I just want you to consider that. And the final thought is the big four bank control, wait for it, 93% of Australia's home loan market. That totals about $1.9 trillion. Again, that's $1.9 trillion. That means most Aussies with a mortgage are likely dealing with one of the big four banks. So lastly, this is why you should be considering trading or investing in our banks.